All right, everybody, welcome to tonight's presentation. I've got 6 o'clock Eastern here on the dot, so we're going to go ahead and get started. Before we dive in, first off, I want to say welcome. Tonight we're going to be talking about itemized deductions versus standard deductions. I think back to my college days, and whenever they'd start a lecture, they'd always tell you what class you're in to make sure you're in the right place. But you guys have made it here on your own. You probably know what you're here for. We're talking about Schedule A deductions tonight versus standard deductions. We're going to be running through about 40 slides of information here where we'll be really diving into the topic in detail and really getting down to, I'd say, the granular level of the differences between the two and the details associated with each of these deductions that are available out there. Tonight I'm joined by Derek North. He's an enrolled agent here at Federal Direct and one of our premier account reps. For those of you that are regulars to the webinars, he's very familiar to you. And those of you guys that are Federal Direct partner offices, you've probably picked his brain on a number of occasions on some of your higher level tax questions that you might have. But tonight he's going to be taking the lead on this, done most of the homework behind it. But before we officially get in here, just a little bit of housekeeping, so to speak. We do have a couple of polling questions that I will be asking you throughout the presentation. There will be 2 questions that we will have, and those polling questions, really I guess I should say it doesn't really matter if you get them right or wrong, but you do need to answer them. The real purpose behind those questions is simply to make sure that you guys are awake and paying attention on the other end of this presentation. Since you receive continuing education credits for simply attending and you don't have to take a quiz at the end of the presentation, they want to make sure that you're not snoozing on the other end. So keep your eyes peeled for those. I'll make sure that you guys have enough time and enough warning to answer those questions so we can indicate your attendance on here. Also, we do have some handouts attached to the presentation. Feel free to take a look at the right-hand panel there on your screen. You'll have a handout section. We do have the PowerPoint file that we're going to be walking through tonight available there for download, as well as 2 separate attachments also that we'll go into detail on throughout the presentation. But one of them is a valuation guide for charitable donations. This one in particular is produced by Goodwill. And also we have an itemized deduction worksheet that you guys can use in there in your tax practice when you're perhaps trying to speed up preparation or trying to help your clients identify all of their donations properly. If you have questions as we're going through the presentation, you also have the ability to type in a question over there in the question panel. And once you type that in, Derek or I might jump on that question immediately, or we might choose to hold off a little bit if we think we're going to be covering that topic throughout the webinar a little bit later. We will also open up the floor for questions and do a live question and answer session at the end of the presentation. So if something strikes you that we've already talked about, or maybe it hits you later in the presentation, write that down, keep an eye on it. You can go ahead and type it into the question panel if you want, but we will try to address that and discuss it a little bit for the benefit of everybody at the end of the webinar. So with that being said, Derek, are you there? Are you live?
Yeah, I'm good to go.
Fantastic. I'm going to go ahead and turn this over to you, and we can go ahead and get going.
Okay, so tonight we're going to be covering basically itemized deductions, more importantly, the itemized deductions out of the 2. And standard deductions will get their own section, but there's really not much, as you'll see as we go along, to really do with those. It's just pretty much an automatic thing. So most of this is going to be on itemized deductions. In either case, the rather plainly descriptive title here is pretty much sums it up exactly what we're going to be covering. More specifically, our course objectives tonight, we're going to be explaining the differences between itemized and standard deductions. There's a lot of terminology, especially for people with little or no experience in taxation. A lot of terminology that people get mixed up. Deductions, expenses, credits. A lot of these things mean the same thing to someone who has never been informed of the difference. We're going to cover when and when not to itemize, or more specifically, how to itemize and what requirements must be met in order to do so. Typically, if you can, it's usually almost always better. Identifying the deductibility of certain tax-related items. We're going to cover the record retention rules and the scope that it applies to your office in terms of what you need to keep, what type of professional responsibilities you need to have. I'm going to identify the difference between deductions and expenses. It's harkening back to some of those differences between itemized and standard. There's a lot of things that are expenses that go on their own forms, like your Schedule C's and your E's, that don't belong on the Schedule A. Different places for different things. Going to differentiate between itemized deductions and adjustments. And we're also going to cover due diligence rules in regards to itemizing to sort of tie into the record retention rules and scope. First things first, what is the difference? You hear the word deduction, it sounds like the same thing, so what is the actual difference? First and foremost, standard deduction. It is a flat amount that's available to every taxpayer. There is no taxpayer in the country on an individual level that is not going to have access to a standard deduction in some format. The value of that deduction is based on the filing status. So it's going to basically scale up. As you start from single or married filing separate, move your way up to married filing joint, it's going to have a flat amount that's going to scale. There are additional amounts for legal blindness and age, in this case 65 or older. Once either of those, or one or both, and it can also be applied individually to a spouse or both spouses or none, those can also raise the deduction amount. There's no proof or receipts required at all. A standard deduction is just a reflection of what the government considers the cost of living portion of annual expenses for basic subsistence in the country. So that value is how much they think that the average person needs to basically just survive. And so there's nothing anyone needs to do. It's just automatic on every return by default. You have to essentially qualify and fill out the paperwork in order to itemize and take more than that number. Itemized deductions are different for every single person on every return. It is a calculated value. You have to identify the qualifying expenses and place them on the forms. And by the strict definition in the code, taxpayer must retain proof of those expenses. If the IRS ever questions it, you have to dig those out and basically justify anything you put on the Schedule A. That's really no different than anything else that's ever claimed on a tax return. So nothing really new here. When it comes down to standard deductions, these amounts that we have listed here are for tax year 2015. Anybody that's new to this, the tax year itself is always in the calendar year afterwards. So calendar year 2016, aka this coming January, is going to be tax year 2015. It always takes place after the year. For your single and married filing separate, you've got $6,300. So that's pretty much $6,300 that's going to count against your taxable income. You've got your married filing joint and qualifying widower, which is double that at $12,600, and your head of household, which is in between the two at $9,250. You can see that there are additional amounts listed here for blind, elderly, and blind, elderly exemption. It's the same for either one. So in the case, for instance, of a single taxpayer, that's $6,300. If he happened to be blind, he'd get an additional $1,550. If he was elderly, he'd get a $1,550 extra. If he was both of those things, then he'd be looking at basically $3,100 extra dollars on top of it. So like I said, they're tracked independently per person. In terms of the software, virtually all software platforms across the country, any that I've ever seen, have checkboxes that just automatically add it for you. There's no actual math involved. It's a checkbox and move on. So I'll just keep this up for one more second for anybody else who's out there maybe taking notes while they're working on this and listening to me. $6,300 single, married filing separate. qualifying widower and a joint filer's got 12,600, head of household pretty much smack dab in the middle with 9,250. Dependents filing their own returns, believe it or not, that is possible. Just because someone has claimed you or claimed a person on a return doesn't mean that person might not have their own tax liability, might not have their own return filing requirements. Typically, you've got essentially two figures you're tracking simultaneously to figure out what their standard deduction amount is. For the most part, anybody that's being claimed on a tax return as a dependent probably is not going to be working, because for the most part it's going to be minor children, or if they are working, it's a very small number. However, they do get their own standard deduction that essentially ranges from whichever figure breaks the threshold up to $6,300. So they can potentially have a standard deduction that is the size of your regular singular amount, and essentially their deduction cannot exceed the greater of either $1,050 or their earned income plus $350 up to $6,300. And I know that's a lot of numbers that are just basically flying around, but basically their standard deduction is either $1,050 or whatever money they earned plus $350, whichever one is greater, and then once it hits $6,300 it stops. Once again, you are talking about something that is handled in the software. I've never seen it in any version of the software where it doesn't basically have an option that says, hey, I am a dependent being claimed on another return. Software does some number magic in the background, out of sight, out of mind. So you probably won't ever have to really worry about that too much, because you'll check a box and move on. But if you ever are brought into the fold of hand calculating a return or checking it, you're going to pick the larger of either $1,050 or their earned income plus $350. Up to that $6,300 maximum amount. To give a couple of scenarios to sort of describe it, scenario number one, no earned income, kid's got a savings account, maybe the parents put money into it in his name for good grades or something, less than $100 of interest during the year. So what you're looking at for him, standard deduction of $1,050. He doesn't have any earned income, so 0 plus 350 is not the greater of the two numbers, so he gets the flat 1,050. Scenario number two, we got a dependent with a summer job. Maybe he's 15, 16 years old, delivers pizzas. He's still being claimed on the parent's return. He earned $3,500 during the year. You're looking at a standard deduction for him of $3,850, which is that earned income plus 350. This number is larger than the 1,050 that was mentioned in the prior slide. So he's going to take the larger of the two. Now, if he maybe earned $7,000 instead of $3,500, then his would just be capped at $6,300. And once again, the software would pretty much take care of it. We're about ready to go into itemized deductions, which will probably, for the most part, be what we talk about for the remainder of the time that we're here. So these three slides basically encapsulate the entire thing. It's a flat number based on your filing status, and kids get their own special one that's sort of, determined between either how much money they earn or a flat figure, whichever is greater, and that's pretty much it. You don't really do anything else with it. You don't need any record retention or justification. This is just automatic. It's just as plain and simple as being on the form. It doesn't do anything else. Just pretty much standard, to make a pun about it. In terms of itemized deductions, there are a couple of misconceptions. These misconceptions, or misconceptions in general, tend to plague public perception of taxes, but these ones are especially pernicious because people will hear the word deduction and some of these things pop into mind. One is that deductions are dollar-for-dollar credits towards tax liability. A lot of people are under the mistaken assumption that every dollar of deductions automatically is a dollar off your taxes. Doesn't work like that. It's a little bit more complicated. Number two is that claiming deductions gets you a full reimbursement at the end of the year. Basically, that whatever you spend is essentially credited back to you, your income or something. It kind of goes for the dollar-for-dollar credits, but some people are of the opinion that the money that you're spending on deductions just basically gets added to your refund, or should. That's not a very fun conversation to have if you've ever had it before, but it is one that is semi-common. Number three is anything that you have a receipt for is a deduction. That ties into the next one, that living expenses are deductible. Those types of things are not. And the one right above it, they're basically two sides of the same coin. I've seen people try to deduct groceries. I've seen people try to deduct everything from like their personal entertainment expenses, basically everything that they bought out of pocket during the year being claimed against their taxes. At its core, taxation is about tracking your income. So the only expenses you're really going to be able to claim have to usually go towards an income-producing activity. Buying your own food and paying your water bill is not going to really be one of those things except in the rarest of circumstances. And another common one is that special needs, elderly dependents, social security disability, all of these types of things let you take more deductions. It is definitely true that you do get a disability increase to a standard deduction, but other than that, there's really no just outright extra money or special tax rates or anything for special needs, elderly dependents, social security disability. They don't give you more credits. They don't make your EIC higher. Even though that's not even an itemized deduction issue, these misconceptions are fairly common when you are talking to someone and doing the interview process. This gives you an opportunity to expand your service by describing to them what is an actual deduction, let them know, might help them plan better in the future, might help them keep better records, or provide you more accurate information to make your job a lot easier. The truth about tax deductions is that they offset taxable income. So an example of offsetting taxable income is, you see right there, 10% tax bracket. It's basically 10 cents for every dollar of deductions, 25% tax bracket, 25 cents per dollar, and so on. There are many tax brackets, we've got 10, 25, all the way up to 38.6 or 39.6, I think. And what you have is a figure that after your deductions is put to the tax rate. So this little formula right here sort of describes how the process works. All of your taxable income gets combined together. You take away any adjustments to income that are on the front page of the 1040. We've got different webinars that cover that topic, but there are deductions that basically take money right off the top. You get your exemptions, which is just a flat dollar amount per qualified taxpayer or dependent. And then you take your deductions, whether it's standard or itemized, and what this equals is taxable income. Your taxable income is almost always going to be smaller, like much smaller, especially for people who are not super rich. It's going to be much smaller than the initial amount for their adjusted gross income. That figure, that taxable income figure, is what's compared to the tax charts to determine how much money they actually owe in regular income taxes. The deductions reduce that figure. So when you have more deductions, reduces your taxable income, that means less tax to pay. And that's pretty much how it works. It's not a dollar for dollar thing. There are different rules for different types of categories, but overall, taking deductions, especially if you are itemizing, it's gonna help you by lowering your taxable income. It is possible to have pretty much have deductions that are more than your taxable income, especially if you are dealing with a low income market and you're on that page 2 of the 1040, you can see the taxable income at 0. In which case the only taxes they would be getting would be from things like self-employment tax or penalties on their IRAs or so on. Itemized deductions are only beneficial if they are greater than the standard deduction amounts. That's the fundamental rule on when you are capable of itemizing for the vast majority of taxpayers who do so. Just outright, you're only looking at roughly 1/3 of taxpayers over the whole country who actually even can itemize, and of that, not even all of them actually end up doing so. And most of the people that end up doing it are usually property owners. They're paying mortgages because that's probably your single largest itemized deduction for most people. If your itemized deductions after they go on the Schedule A are not bigger than your standard deduction amounts, then you don't itemize. It's more beneficial to take the standard. You don't need to worry about filling out the Schedule A. You don't need to keep those records because they're not going on the return. They're technically irrelevant. Deductions also handle only ordinary income tax. Your taxable income I mentioned earlier is on its separate spot on the back of the form, and it basically stays there, and it handles ordinary income tax. Deductions in general do not reduce taxes in the other taxes section of the return. Your self-employment tax for your Schedule C people, your IRA penalties for taking money out of your 401k early, shared responsibility payments because you got a little bit too much money in premium tax credit and you got to pay it back. None of those things are part of the taxable income. They are added after the fact. Deductions do nothing to them. It's a common thing every year for someone to come in. They've got a couple of different clients, some of them doing Schedule Cs, some of them doing W-2s, and the people who are doing W-2s usually get bigger refunds because they've been paying into the system all year with their self-employment tax or with their Social Security and Medicare taxes. They don't have to pay self-employment tax out of that income at the time of filing. So basically, that's what's happening there. Your deductions don't touch that. Those are calculated separately. It's also important to remember that some deductions can be audit magnets. Basically, the potential for abuse for some of these is fairly high. 2106, which is your unreimbursed employee-related business expenses, i.e. money you spend out of pocket on your traditional W-2 job, like maybe you're a repairman or not really a contractor, but you're working for somebody and you got to pay out of pocket for travel or for equipment or education. You can claim a lot of those things on the Schedule A if they meet the requirements. A lot of people will just make up numbers and throw it on there. Giving too much money to charity, you want to use common sense. If you have someone sitting at you at your desk and they are giving you the information to itemize these returns, you don't want to deduct personal expenses as business expenses, so don't put the groceries on the 2106. You don't want any egregious business use of home. Someone comes in and says, yeah, I use half of my house as an office. I've seen it. It's an immediate red flag. You got to pay attention and stuff like that. Or maybe somebody comes in and says they give half their money to charity. They're low income. They're making $15,000 a year, and they're trying to tell you that they donate like $8,000 of it to charity. Maybe in the rare instance you find someone that really does apply to. I've never actually seen it be legitimate. Usually, once it's explained that that's not really helping them, the claim sort of vanishes. So if it seems a little bit egregious, don't be bothered. Don't feel sad or upset at the fact that you might need to ask more questions. That it's okay to disbelieve some of this stuff to get more clarification. It could be a big misconception. I said before that there's a lot of that in this industry, especially with deductions. So just be on your toes, and if it looks suspicious, see if you can get some documentation. There's nothing wrong with that. When to itemize. Going back to that core rule, if I hop back a page, only if it's greater than the standard deduction amount. That standard deduction amount I showed you earlier, $6,300, $12,600, $9,250. Look at their filing status, look at the expenses, or look at the costs that they're trying to itemize. If those costs just flat out don't even approach that standard deduction, don't worry about it. I mean, you can take the information down, put it in the return, and then when you're done, you can show them why it didn't matter, if that helps soothe their conscience about it. But generally speaking, if you're looking at their expenses together and you don't see anything that stands out, you want it to be higher than that figure outright. And some of this stuff does get modified by certain percentages and actually drops in value. So you can have enough up front, stick it on the Schedule A, and it still doesn't matter. That's definitely something to keep in mind. Most common one that is going to help most people, mortgage interest and property taxes. Those are the things that typically push people to itemize deductions, because usually you've got a 30-year fixed mortgage. They're paying thousands of dollars a year in mortgage interest and potentially thousands of dollars on the value of their home and property taxes. It all comes on their 1098 form that they get from their lender that spells it out for you all in one place, a couple of lines on the Schedule A, and that right there is the bulk of it. You've also got sales tax on large ticket items, autos, boats, certain other types of personal property, material purchases for remodeling your home. There are certain large purchases that the IRS has in their system that allow you to take the sales tax on them. We'll talk more about sales and local taxes basically in an upcoming slide. But for the most part, sales taxes on these large ticket items, you're going to want to probe about that, especially if you're looking for more things to stick on there. Excessive unreimbursed employee-related business expenses for a W-2 job. This is going to be quite honestly, most of the time is going to apply to business professionals who have to travel and people who are in the technical fields, whether a cable repairman, a mechanic. A lot of these people will be buying and paying for their own tools, those types of things. Excessive state and local taxes paid. You get to deduct state and local taxes on your itemization in the software that we use, and pretty much all the other ones, they automatically carry from the W-2s that you complete. So for the most part, that'll just automatically be on the return as you fill out their wage information. And in this particular instance, the taxes can pay if you live in a really high income area, East Coast, large cities where people are paying maybe 1, 2, 3, or even more taxing jurisdictions income taxes, especially on border states or places with reciprocal arrangements. That can also drive it up. You do have also married filing separate and the spouse is itemizing. I've got a little box on the side that says necessity. If you do have somebody who is filing separate, their wife and them or their husband or whichever one of their spousal partners is filing a separate return and that spouse is itemizing their return, your client is going to have to itemize as well. They either take the standard or they both itemize. There's no mixing and matching. And this is one of the few times where you can actually have a client itemize and have less expenses on that or less deductions on that than the standard deduction, and it actually harms them. So if you do have someone married filing separate, make sure, in general, you want to get information on the other spouse because you're going to need their name and their social. Find out if that spouse is itemizing. You don't need to do a return and see like a nice refund check coming in only for John Doe to get a letter in the mail a month later that says, hey, you need to itemize your return, and that nice refund turns into a gigantic tax bill. We do have an itemized deduction worksheet that is available through the partner portal, and there is one attached in the handout section on the side of your screen if you haven't already downloaded it. I would definitely recommend taking that, keeping copies of it, having people fill it out. Usually, since it's got all the things on there listed out line by line, you can avoid some of the problems during the intake portion by having them fill those lines out instead of you having to dig through stuff and tell them, well, this doesn't work, this works, this doesn't work. It's a very useful tool. Feel free, if you want to as well, modify it however you so choose or create your own version. It's just a useful tool for you, like many of the ones we have on our website. And then the last bit, technically, taxpayers can itemize even if their amounts are less than a standard deduction. If they voluntarily choose to do that, it is their right to do so. It is a terrible idea because it means a higher tax liability. So unless they're just really into the idea of just basically giving the government more money unconditionally, it's a really, really bad idea. I have heard some stories, I believe Joe has some, of taxpayers who voluntarily chose to itemize and have a tax penalty essentially on their return, but it's something that you see like once a decade. It's not a common thing.
Yeah, I guess the one circumstance like that I can think of off the top of my head was a client that had I think he was already out of his bankruptcy filing, but the way that it worked is if their refund was over a certain threshold, it had to go to the bankruptcy trustee or be split with the bankruptcy trustee, whereas if it was underneath that threshold, they got to keep it. So it was one of those odd scenarios that you really don't see much, where your client's asking you, is there a way to reduce the amount of my tax refund? So that was definitely a strange scenario for me, but this was one of those ways where you can go ahead and I guess choose that route and allow them to, I guess, contribute a little bit more to the federal government.
Definitely. Like I said, very rare. That particular instance that you just heard about is literally the only one I've ever actually heard of while I've been doing this job. Most of our senior employees here will handle thousands of returns and calls throughout the year for tax purposes, and that one instance. So you're probably never going to have it happen, but if you do, that is definitely a choice that particular person can make. I got a couple of example slides that just show you, for instance, the deductions interview sheet, what it looks like. You can see a list here for them to fill out and some other miscellaneous itemized deductions in a note section, so that way you could fill it out. A little bullet point on the second page that says, hey, keep records. We haven't really got to that portion of the discussion yet, but it is definitely something I do want to keep in the discussion, is that if they do want to take it on the return, they want to have proof of it. The IRS does not really audit returns very much anymore. Most of the things that they do are requesting information in connection to refundable credits like the earned income credit or child tax credit or the premium tax credit, because those are the biggest areas for fraud, and it's usually handled by an automatic computer process that just mails something out to the address on file. However, in the small instance where you actually do have an IRS agent saying, hey, I'm going to do an actual audit, they need to be able to provide proof for this. Otherwise, the IRS can just basically go, nah, take it off, take it off, and watch that refund, basically drop itself down. We got a couple of shots of the software that we have. The interview-based software for the Silver and Quick Start partnership. There is a question here on the first page of the interview that says, do you want to itemize your deductions? You want to switch that over to yes. If you haven't done so already, you will, before the start of the season that's coming up, have a training, and that training will basically identify, you want to do this probably for every return anyway, because even if you don't itemize, it does actually open up a section that allows you to determine like credits instead of just itemization. So it's sort of mislabeled, and something to keep in mind. So you'll probably just want to switch it to yes by default, because the next page in it basically has a big section of different spots that you can check in the middle of the screen, and then as you add them, they have their own sections that get added right over here where you see new in big red letters and arrows. They add little separate subsections that you'll fill out as they go along, and that will populate it on the return, so that way when you send it to have it processed and finished up by us over here, we're able to properly get that stuff on its appropriate forms. Anybody that's at the gold or the platinum level or higher that has access to the professional software, whether it's online or desktop, essentially will have a Schedule A in the list of forms and have the ability to type the information directly on. If we do have time towards the end of the presentation, I will hop into an example return just to actually show you what it looks like and how to operate inside of it. Just to give you a sort of a broad, glossy overview of what you'd be dealing with. This right here is the online interface, and the desktop interface is identical, just different colors and button arrangements, but essentially the same thing. You'll see a Schedule A over here on the left-hand side. You'll see the form itself over here in the actual window that you can work on with different colors determining, what fields are required, what ones are calculated, and so on. Now I can actually get into the expenses themselves. When it comes down to the expenses themselves, I did mention that there are a lot of personal expenses that are basically not deductible. There are some that are, however. One of those are basically medical expenses. Medical and dental, anything that is essentially required for your health, you do have the ability to deduct some of it. You have a requirement, strictly speaking, that it must exceed 10% of your AGI. So whatever your adjusted gross income is, you need to have more expenses than that. So if at the end of the year you're dealing, you're sitting there looking at an AGI maybe of 50,000, then you are going to be required to have more than 10% of that in order to deduct it. So you got your $50,000. You need to basically spend more than $5,000 on your medical expenses in order to claim it. If the person is age 65 or older and elderly, they get a 7.5%, which is the old percentage that used to exist prior to the passage of the Patient Protection and Affordable Care Act, the Obamacare. They get that until 2016. 2017 onward, they will be back up to 10% like everybody else. You can deduct your health, dental, and long-term care premium payments. You can deduct your prescription costs, acupuncture, chiropractors, eye doctors, psychiatrists, weight loss programs. There's a little addendum here that they must be treatments for disease diagnosed by a doctor, no self-diagnose and purchase. And that pretty much applies to about most of the stuff on here, is it needs to be given to you as a treatment or a course of medication or something by a professional. The acupuncture and chiropractor, regardless of what your stance is on whether that's considered medicine or not, they do allow it. But the idea being that a professional who is certified to provide either medical advice or remediative therapy or something has to actually give his professional opinion that you need it and has to be prescribed, and then you can take those payments. So if you just look in the scale one day and say, oh, I'm a little overweight, and you go get yourself a Nutrisystem, can't take it, it would be your best bet to get a letter from a doctor. I've even seen people who, believe it or not, will walk into one of those walk-in clinics at like the CVS or something, pay the $50, have them look them up and down and go, yep, you need to be on a weight loss therapy, eat this much of this type of food, and then try and do it. I mean, I've seen weirder things happen, but long and short of it, needs to be professionally prescribed. You also can do treatments for drug and alcohol addiction. And there are certain things that do not necessarily need to be prescribed in terms of like physical purchases. Eyeglasses, you typically have a prescription for that, but eyeglasses do count, so you don't have to get a prescription every time you buy a new pair. Contacts, wheelchairs, hearing aids, LASIK surgery, crutches. There are certain types of things like that. There's a little section on here, lactation supplies for nursing mothers. Those types of things can be purchased over the counter and not necessarily need a prescription, but there's a very small amount of those that do fit it, and almost all of them are usually devices or support structures. You can't go buy like a knee brace, for instance, like a little elastic Velcro knee brace and have it count, but a set of crutches would work, or eyeglasses, so those types of things. Smoking cessation programs, those can't have the over-the-counter thing, so your gum and your patches or even the vapes can't qualify. If it's prescribed by a doctor, then it's cool. If you're talking about mileage for medical care, you do have this as a possibility. It is often overlooked. If you are driving for medical care, start keeping a mileage log. Even if it's just a little notepad that you jotted, today I went, 10 miles to the doctor. Keep that information, so if it's ever, asked, you have proof for it. Even if there's no way for them to independently verify because you're not GPS tracking yourself as you travel to the doctor, a simple notebook with dates and mileage is sufficient to satisfy the requirement for the most part, and I can't think of a single instance where they've even really challenged that, unless the person is like, oh, I drove 50,000 miles to the hospital. You know what I'm saying? Not a real big concern for most of the time. It is very often overlooked. If you go to the doctor, keep a little mileage log. Maybe if you do have the ability to itemize, you might be able to get a benefit out of it. All of this stuff pretty much is also contained in Publication 502. Every single IRS publication and form is available at all times through the web. You can also contact them manually and have them send you copies. I think they might have a nominal charge for shipping. In either case, it's all available. If you go to any web search, Google, Bing, whatever, type in Publication 502, absolutely 100% of the time, top link is going to be to an IRS website. Deducting taxes that you paid. Taxes are, generally speaking, deductible in just about every single case. If you pay a tax, it's pretty much deductible. There are a couple of rules over that. It's not necessarily explicitly stated on this particular slide, but we kind of touch on it as we go through the different categories. They typically have to be what's known as apportioned, which means that they apply to everybody and they're based off of a value. In the case of your local or your state or local income taxes, if you're looking at local income taxes, they're applied to everybody who works in the state, and it's a percentage that's based upon the income that you make. That right there works perfectly fine. So when you drop it on the W-2 in the software, it's going to hop right on your Schedule A, and it's going to deduct itself or add itself to the total. You can use the actual taxes off of your W-2s, or you can use the local tax table. The local tax table is contained in the instructions for the Schedule A, but you don't have to worry about that because about every single commercially available software has the ability to basically toggle or add a worksheet that allows you to calculate what your figure should be for the state that you live in. So what this does is this allows you to choose different types of taxing schema based upon what state you're in. 43 of the states in the country have income taxes and are just deducted like normal. The remaining the remaining states have a sales tax that they apply at the time of purchase for most goods that you will buy in stores in that particular state. This allows you to pick or choose whichever one you want to do. You need to do either or, not both. So if you are living in Oregon, or Washington State, where they don't have, your local or your state income taxes, then you'll be able to do the sales tax instead. The sales tax can be done with actual receipts. It's a pain, and it happens to a couple people a year. They save every single receipt that they have, no matter where they went, whether they went to a fast food restaurant, to the gas station, whether they went to Walmart, grocery store. They save all of their receipts, and if you're lucky, they'll total all the sales tax for you. Otherwise, you might be spending an evening digging through a shoebox full of receipts and using a calculator. The easier way to do that is to use a tax table, in which case it'll just generate a figure based on their income, and it'll just go right on the worksheet and then therefore right onto the Schedule A. Most of the time, if you have the ability to choose between the two, your actual income taxes for the states that have them will be a larger amount. Regardless of the method you use, however, you can still claim sales tax paid on large purchases, cars, boats, materials for renovating your house. Those types of things, like big, solid purchases where you're paying a substantial sum in sales tax, you will be able to add that on that sales tax worksheet and have that count in addition to your regular income taxes. So that's pretty much it. If we do get a chance to get into an actual return, I'll probably add that form and show you exactly what I'm talking about as well. For the real estate taxes, only the amount actually paid, not the amount assessed. That's a real common one. They'll get a letter from their county that says, hey, this is how much you owe in taxes. They don't pay anything. Maybe they wait until the end of the year, but maybe they're late on it. They don't get to claim what they didn't pay. It's only the amount that you actually physically pay, not the value of the assessment. A lot of property and real estate taxes are done on non-calendar specific. A lot of them will mimic, for instance, the federal government's fiscal calendar, which has its beginnings in September. So you're looking at sometimes it being off the calendar rating was what you actually paid. Now, if you're paying that through your mortgage provider, then it'll probably be right there on your 1098. Otherwise, you'll have to maintain independent receipts in order to prove that if it's ever questioned. When you are deducting a real estate tax, it has to be uniformly levied across the jurisdiction. So you don't get to take a little one-off tax. So maybe they're building a new road or a stadium or something in your area. They charge you, your neighborhood, or a couple of blocks an assessment. Or an easement or something on your property. You don't get to claim that as a tax. Any type of those taxes will just add to your basis, which will just lower the amount of gain that you have to report if you ever do sell the property. That's an entirely separate discussion, but it has to be everybody inside that taxing jurisdiction. So whoever's charging that tax, they have to apply that to everybody uniformly. Personal property tax, those can be cars, boats, things like that. It has to be based on the value of the property and imposed annually, even if it's not collected annually. For example, some East Coast states with annual assessment only collect every 2 years. I believe Connecticut's one of those where they will calculate the value and you have to pay it every 2 years. It's assessed annually and it is based on the value of the property, therefore it's deductible. That needs to be uniformly levied across the jurisdiction, same as real estate taxes. A good example would be getting your car registered. In our state, Indiana, your license plate fees are based on the value of the vehicle. So if you have a really expensive vehicle, you get a bigger bill, deductible. In Texas, unless something's changed that I'm unaware of, it's a flat fee. It's not based on the value, technically not deductible because it's more of a fee instead of a tax because it's not considered apportioned. And there's no authority constitutionally to pull that out, so it would be non-deductible. Taxes paid to a foreign country needs to be paid in tax to a foreign jurisdiction. It might be better to take a credit for the taxes paid instead of a deduction. Most people are not going to deal with this. There might be a potential person in the audience or two that I have worked with in the past, if I'm looking at this list correctly, who have actually had to have a little bit of work done. Most of the time, if you're paying taxes to a foreign country, it's better to take a credit through what's called a Form 1116. 99% of the people that work with us, never going to have to worry about it. But for those that do, usually better to take a credit. However, sometimes it's maybe too much of a hassle. It's just easier to take the United States dollar value and then get a credit or get a deduction instead and put it on the Schedule A. Might work better. A lot of these types of things have an either-or option. In this case, if they do decide to do a deduction instead of a credit, they do actually get to take it, the amounts paid, and subject to its own rules. Home mortgage interest. I mentioned this earlier because it is very important and it's very common. These are going to be interest on your first and second mortgage, so basically on both primary and second homes. So if you got two homes, you could technically claim this. Got to keep in mind that this is talking about personal usage of the property. If you are using a home or the second home for business purposes in either in full or in part, then those mortgage expenses will go on their appropriate business income related forms in whole or in part, and we'll cover that a little bit later towards the end of the presentation. This includes interest on home equity loans. So maybe you own the home, you take out a home equity loan to get a little bit of cash, maybe do some renovation or finance something or do anything you want with it, and you're paying interest on it. It's the same thing. Interest on refinanced mortgages, also deductible. What is considered a home for the purposes of this? House, condo, mobile home, boat home. Essentially, the way it comes down, or it's come down in the court, is that it has to have a sleeping area, a toilet, and a cooking area. If it has all three of those things, and it is the intention of the occupant to use them for that purpose, and you have a mortgage connected to that property, then you're probably going to be good to be able to deduct that interest. The loan itself must also be secured by the property. And when it says that it can be secured by the property, what that means is that if you default, if you can't make the payments, the mortgage goes underwater, that the person who gave you the loan in the first place has the ability to take that property and satisfy payment. It basically means your home has to be the main source of collateral for the loan. So if it's not secured by the property, if there's no recourse for the mortgage, then there's no ability to deduct it. If the bank has the ability to walk in your door and say, you have not paid this and we are going to take your home from you, if they don't have the ability to do that, can't claim it. If they can, then it is considered secured. There are a couple of other situations that could potentially change the definition of what is secured. Some people may have heard of wraparound mortgages, some of the other type of arrangements that exist, but generally speaking, you need to be able to lose the home. It needs to be the collateral. The deductible portion also only pertains to the first $1 million in the value of the home. If you are over $1 million in value, you need to prorate it. So if you are buying a house that's worth $2 million and you're trying to deduct the interest, you can only take half on the interest on that mortgage because you're prorating, and $1 million is half of two, and so on and so forth. Most home values are probably not going to approach that. Even in the really nice areas in the country, most of your upper tier home values are probably $300,000, $400,000, $500,000. And some of the richer areas, maybe like DC Beltway, outside of northern Indianapolis, for instance, probably not going to worry about it too much. If you do notice it or you see a large interest amount, ask them, how much was your home worth? How much was your home worth, so that way you can determine whether or not you need to prorate it. When it comes to home mortgage interest as well, there's also points. Points are just basically percentages off the mortgage. In order to deduct them, I mean, that's a real basic explanation, but if you do have points, they will be separately stated on the 1098 that you use in order to show how much taxes and how much interest and principal you paid. They can be deducted if all of the following are true. It is common in the area, and it's not more than the usual amount. So you can't have like the loan provider give you a special deal where they do points, but it doesn't happen to anyone else, or give you more points than they would normally charge to the people in the area. The loan has to be secured by the main home, same way as it would for mortgage interest. Cash method and amounts are not paid for separately stated items like appraisal fees. So when they say cash method of accounting, what they mean is that you are doing the cash method of accounting and the value of the income and cost that you're incurring are done on a calendar year basis or within the basis of your tax period. They don't include amounts for stuff in the future. There's no accounts receivable. 99% of the people that have mortgages, that's probably not an accurate figure, but it's probably pretty close to it, going to be cash method. Vast majority of people do cash method. Accrual basis or any of the hybrid methods, those are usually for businesses with inventory or like film companies or something. Not really something you got to worry about. And the amounts, that the second part's the most important, is the amounts cannot be paid for separately stated items like appraisal fees. They can't have you pay points off of the mortgage to satisfy things like paying your realtor or paying engineers to give you a thumbs up on the house. It has to be towards the actual ownership of the house, go towards that principal balance of the mortgage. The funds that are provided and any points that the seller paid are at least as much as the points charged. There's no borrowing from the lender or broker to pay the points. So if you're paying points off, you can't, get money from the lender or from your real estate broker or any of this other stuff to pay it on the behalf and then basically get to take those in addition to the amount you're charging on the mortgage. Instead, that would just add itself to the mortgage and you'd collect the interest like normal for the duration of it. The loan has to be used to buy or build the main home. It has to be computed as a percentage of the principal, aka the percentage of the actual amount lended. And it has to be clearly shown on the settlement statement. If the person you're working with or they've got a mortgage where it's just the paperwork's just a mess, and need to get that corrected so that way the points are very clearly stated as being points and they can be shown to satisfy most of these requirements. You do also have the ability to claim mortgage insurance premiums. For those of you that don't own homes or don't know much about this procedure, typically if you are getting a mortgage and you have paid less than 20% of that house's value off, either you had a smaller down payment than 20% or you have been paying and you're under it, you're usually required to have insurance premiums to help satisfy protection for the bank. Until you hit that 20% mark. Those are deductible if they are qualified. VA loans, Federal Housing Authority, most private loans that you have can have a mortgage insurance premium attached to it. You get a full deduction of the amount that you paid on those premiums if you've got an AGI under $100,000. As your income goes up from 100 to 109,000, it basically just reduces until you hit 1,000 or $109,001. Once you're over 109K, can't claim the mortgage insurance premiums anymore. So this is just more of a benefit to people who are technically in the the middle income category, because the your income range is probably not going to be satisfied by a lot of the people who are buying homes and having to pay mortgage insurance premiums. So they get these benefits up to 100,000, and it starts to drop until it hits 109. If you are married filing separate, and this is one of the many ways that the married filing separate filing status tends to degrade the quality of your end tax result, these figures are halved. So you start hitting that limitation when you hit 50,000 up to 54,500.
Hey Derek, before you jump into charitable giving here, we're we're a little past the halfway mark. Why don't we go ahead and fire out one of the polling questions here?
Sure thing.
All right, we're going to go ahead and launch one here, and let's just put this one out there. I want to see how good you guys are. We've referenced this a little bit throughout the presentation, but itemized deductions are reported to the IRS on what form? Schedule C, Schedule B, Schedule A, or the Form 8962? Go ahead, make your choice on the screen there. Again, if you don't know, it doesn't really matter if you get this right or not. Just be, please make sure that you do answer one of those four options. That way we can identify that you're awake and paying attention on the other line there. Again, what form are itemized deductions reported to the IRS on? Schedule C, Schedule B, Schedule A, or the 8962? We'll leave it up here for another minute so you guys can all get an opportunity to respond. Looks like just about everybody's already answered here, but got just a couple of you out there that we do still need to get an answer in there for. So we'll leave it up for about another 10 more seconds here, give you guys a chance. But otherwise, pretty straightforward for those of you guys that have worked with returns before. Schedule C, Schedule B, Schedule A, or the Form 8962. Go ahead and shut it down here in 5, 4, 3, 2, 1. And then I'll go ahead and post that up there for you. And it looks like we really got that just about 100% there. Schedule A is correct. That's where itemized deductions are going to be listed out. We are going to be talking a little bit later in the presentation here about expenses versus deductions, and that might have been what tripped up 6% of you out there indicating Schedule C. But Schedule A is what you want there. Thanks for your guys' response on that. I'll go ahead and close that one out. And Derek, I'll let you continue on. Thanks a lot.
No problem. Okay, so we've gotten through a lot of the really big ticket items. This next section, charitable giving, is a very interesting field because a lot of people will donate and get basically a tax benefit out of it, and it's subject to a fairly substantial amount of rules. Is going to kind of copy itself over the next few slides. So first off, qualifying organizations: religious, churches, mosques, synagogues, temples. It doesn't really matter if they are considered a religious organization. By default, the IRS is going to automatically consider them qualified for 501c3 status, and any deductions to them, assuming that they have filled out whatever required paperwork they need to get registered, are going to be considered deductible. You do have the ability, and this is something I might talk about in a different webinar at some point, to keep in mind, is that any religious organization, really any charitable organization that can technically be deductible where you give the contributions to, are going to be available on the IRS's website. You can look up every single one of them that actually has gone through and filed a return with the IRS. You can see how much money they make, how much money they spend, how much they pay people. So if you see somebody trying to donate, for instance, to a church or something, and you're curious about it, you do have the ability to independently verify whether or not that organization is capable of being qualified. They actually even have a nice little state-based map that you can click and get an Excel spreadsheet that you can look at all of that information and find whatever information you need to verify that it's actually deductible. This also includes charitable organizations: Red Cross, United Way, Goodwill, Doctors Without Borders, any of these things that have registered for their own 501 statuses to provide nonprofit services to the community, going to be deductible. Educational: Boy Scouts, nonprofit schools, certain types of schools that might not fit either one of those two. I mean, they're all going to be nonprofit, but the large amount of different things out there that qualify for this. Scientific, the Susan G. Komen Fight for a Cure, different children's hospitals or medical organizations, things that prevent cruelty to children or animals. So the Humane Society, the ASPCA, a lot of these types of things are going to be considered deductible. Most people are probably going to be donating to places that are fairly well known, or they will just have a total figure for you and then they'll justify it if they ever had to in the future. And the types of donations that you can get are going to be cash, check, or charge, just a simple monetary value; a non-cash donation where you are donating property, whether that's something like clothing, all the way to electronic devices or cars, or even whole property lots. There's also mileage driven for charitable purposes, similar in scope to the medical deduction. If you're going to be doing mileage for charitable purposes, keep mileage logs. Any type of thing that requires mileage, just general rule, have a little notebook, jot it down. If you don't have a notebook, stick it in your phone as an email to yourself or a text message to yourself or something. Keep a record of it, consolidate it later for record-keeping purposes. When it comes to cash donations, you technically must have records to prove all of them: canceled checks, credit card statements, or written receipts from the charity. And anytime that you do have something, like maybe you're putting cash in a collection plate, a lot of that stuff is going to be tracked. A lot of churches now are onto this, and they're fairly straightforward. Any major church in a medium-sized city or larger will probably have an option for you to be able to get this information, a written receipt that says, here's our name, here's how much, here's the date that it happened. And you can use that to justify it. I've even seen churches that send around a credit card machine, not joking, where you swipe it, and at the end of the year you get an email that shows you how much money you spent. Like, a lot of churches are getting on top of it. The ones you want to watch out for or make sure that they get records for are the small churches, the really small churches with like maybe only a family membership. I've got family members, for instance, who run their own Baptist church with maybe 35 members in a small town that's not even 10 times the size of that, population. It's very small. That type of thing would be the one you'd want to pressure for that written receipt, because he's not sending a credit card swiper around. For the most part, donations under $250 are going to be pretty much, you keep the record, but no one's really going to say anything or really question or really try to bother the taxpayer over it, because it's just not worth the amount of time and effort on the IRS's behalf. Donations over $250, however, need to have a statement from the charity showing the amount of money contributed and whether any goods or services were given in return. And if there were, they need to be taken away from it. So like a Boys and Girls Club dinner fundraiser, technically the value of the dinner that you eat is going to come out of whatever amount that you donate. So that's something to keep in mind. Most of these people that run these types of fundraising events, they have their own fundraising rules that they have to report to the IRS to show how much money they're spending on the activity. They're probably going to make it very explicitly clear to any donor exactly what the value of their donation is in order to make sure that they're not under fire for tax evasion or something of that nature. The biggest one, the one that causes the most issue, is when it comes to non-cash donations. Donations of non-cash, so property of some kind, whether it's real or whether it's intangible, like access to royalties from a song or a digital product, anything that is donated to an organization must be donated at the fair market value. You need to be able to justify the valuation, and we do have a link that's in this. You can, I'm going to keep this up and kind of talk, yak a little bit, so you might be able to write it down. You could look up, fair market valuation, Goodwill on a search engine of some kind. In either case, Goodwill, and it is also attached in the handout over there on the side, does have an actual booklet that gives you rough values that you can use as a basis to determine the fair market value of property that you donate. Anything over $500 must be entered on a Form 8283. In the software that we use, we are talking about a section that we just add. We link right to it, we fill it out, and it carries itself forward. You are going to need to get some information though. So regardless of whether you're filling out the 8283s or whether you are a silver or quick start partner who's going to have us do it, you're going to need to get some information and make sure to either give it to us or keep it on file to complete that form. The taxpayer needs to keep a written record of that name, address, and date of the organization, just like a cash donation. They need to keep a record of how the value was determined, and if you are talking about something like a boat, an automobile, or an airplane, there must be an attached statement from the charity to your return. Any type of charity that can accept boats, automobiles, or airplanes will probably have these forms ready to go for you whenever you are going through that process, so that way you have a proper amount to deduct. If you do have any large non-cash donation, the main things that you need to keep in mind is you need to know who received it, what it was, where was it donated, when was the property purchased, and how the value of the property was determined. And that can be really straightforward. I've seen just, how was the property determined, resale value. That's the fair market value at the time right there. It's fairly straightforward. Most of the time the IRS is not going to really get into tracking down the value of a particular good on a particular date unless you're talking about some major tax fraud.
Yeah, Derek, I want to jump in here while you got this slide up because I get a lot of questions from this from our offices as well, as far as talking about, my clients donated something to disabled American veterans or Goodwill or something like that, and they simply brought in a generic receipt showing that they gave 5 bags of something, and that's difficult. But what you need to do is you need to take your client at their word. You need to be able to identify what it is that they donated, and then you can look up that fair market value with that tool, like that we have attached over on the sidebar there. You can use or the website, and that will give you a good, I guess, an explainable um, process if the return should ever get audited, when they come up with, well, I show here you've got a receipt that your client donated a used television to Goodwill. How did you come up with a $100 valuation? Well, you need to have some type of explainable logic. And right here is how you can come up with that logic. Use that table, use that fair market value assessment, and be consistent in your use of those type of tools across all of your returns, and especially across all years of the same client's return, in case they would happen to have multiple tax periods being examined. That way, you show that pattern of consistency. It's a legitimate source, and that will ease any pressure that an agent might be maybe putting on an examination of that return. So it was I urge you guys to download that handout over there. It's a very good one, and it does cover most of the items that you're going to see. I think the biggest one I always get is, well, I donated 5 trash bags of baby clothes to Goodwill. How much is that worth? They're asking me that as well. I don't know. Yeah, that's a good question. How big were the trash bags? What were they? And so on. But that will give you a good guide point for coming up with valuation there. So, hey, thanks, Derek.
No problem. And if I have donated things to Goodwill before, and they're by far the largest player nationally in this particular market. So what they say on the valuation is probably going to be the industry standard for what their valuation is. So a lot of times they will give a receipt that's just blank. It says, hey, here's the date and time, and then maybe what it was, or they let the person who donated fill it in. For the actual value. If Goodwill ever got brought into question how valuable that property was, they would just go off of that form because that's what they've set as the standard. And if there's any difference, maybe the object you donated was technically worth more at a fair market value because it was rare or some other feature made it justifiably more, that would be up to that particular taxpayer to keep records of, which is the reason why you need to determine how the value was calculated. So if you do have something that is kind of unique and not just, a generic 5 bags of clothes and a couch, if it was actually unique, maybe get something to justify that. I have seen people go look for that same item online on a purchasing website, or they go to Google and shop and look for that item and see what the average price is that object is going for, and then that's what they use as the value. That's also a way to do it as long as there's proof that the market has determined this property is worth this much, if you're not using that little guide. And even though it's not explicitly stated here, one thing to keep in mind is that you can't get a larger deduction amount than the value that you spent on it. So technically speaking, you couldn't go to a storage lot, buy a whole storage lot of old clothes for $5 and then donate that and get a $500 deduction. There is technically a spot on the 8283 for that $500 or over value where you will have you put down what was the amount that you paid for up front. It's not exact necessarily for most people, but what they're trying to determine is whether the value of the property rose and you would have had a gain from it if you would have sold it to the market instead of donated it. You can't have a larger deduction than what you paid for it. Not that that's ever easily determinable. You're taking your client's word for it, but you want to make sure that if you do get wind of that, that you let them know that they can't technically benefit farm by paying cheaply for a lot of goods and then donating them. If the IRS ever caught wind of it, that's just straight up tax evasion. And they're fairly aggressive when it comes to prosecuting things like that. Another thing, casualty, theft, and loss. Most of your personal expenses in general are not going to be deductible, like your car payments, your groceries, or like buying a TV and stuff. But there is a section that does let you get some value essentially out of it if something happens to your property, to reflect that, the insurance act of God, a storm blows something apart, or anything happens, to basically destroy property. It gets stolen, you have a fire. These are losses that are not reimbursed by insurance. Theft, vandalism, fire, storm, money lost in a failed financial institution, Ponzi scheme victims. Ponzi scheme victims, they actually have a special rule that means that they are not subject to the AGI limitation or a $100 reduction. And the reason why that's brought up is because every loss in each category is reduced by $100. So you lose something worth $1,000, $900. If you lose two things worth $1,000, then you're looking at $800 because each loss, each casualty is reduced by 100. That's also one of the reasons why when people fill out a casualty, theft, and loss, they typically describe it as a lot of property, like a grouping of property, instead of explicitly spelling out each individual item, so that way they can not have the amount of the deduction basically reduced arbitrarily. This is only deductible to the extent that the gross loss is above 10% of the AGI after that $100 limit. So keep that in mind. If you have a car burned down and it turns out it was a beater, a simply point A to point B car that you bought off Craigslist for $500, and you make $50,000 a year, the $400 total casualty impact is well under the $5,000 that would represent your 10% of AGI. I don't want to give everybody a deduction just because you lost something or had something break, so people aren't having deductions every year because they've got a toddler who runs roughshod in the living room. They're talking about the actual type of losses that significantly impact your well-being or incur a significant financial penalty to replace. So it has to be above 10% of the AGI after you reduce each loss by $100. And when you are talking about doing these casualty losses as well, you do want to keep these records for insurance reimbursements. Insurance reimbursements can potentially severely reduce or eliminate entirely the amount of actual impact. If you get all of the money back, that is the value of your property, then you don't have anything to deduct. If you get more money back than what you lost, you have nothing to deduct. So you just want to make sure to keep in mind that if someone did get insurance proceeds from the loss of a property, then you are going to want to make sure and find out how much that is, so that way you can properly determine the amount. And that's going to go on a Form 4684. You can link it in most of the software platforms right off that Schedule A, and use that to help calculate these things out. Some of our practice returns as well actually have this scenario in there that you can figure out when you're finishing them up. On-the-job expenses. This one, like charitable giving, is a big audit magnet because a lot of people abuse this. Because technically you're talking about paying money out of your pocket while you're at your day job, and you're reducing your tax liability, so people will just start throwing everything they can on it to try and make sure that they get a big refund at the end of the year. It goes on what's called a Form 2106. It is subject to what is known as the 2% of AGI floor. And its function, similar to the 10% that we've talked about earlier, is that the expenses need to be over 2% of your AGI. So basically 2% of the money you earn automatically just doesn't count. Any of the expenses when you're on the job need to be considered ordinary and necessary. Your ordinary and necessary means that it is common and accepted in the field of trade, business, or your profession, and necessary does not mean required. It means it has to be helpful and appropriate for your business in order for it to operate. So it's not like one of those things where you're paying money out of pocket, but if you didn't pay it, you would have lost your job. It's not a requirement. It means that it needs to be helpful and appropriate for your business and common and accepted in your field of business. So if you have somebody who is I keep referencing an electrician, a lot of those people are not contractors. They're technically employees, but they're on the hook for their own tools. They're on the hook for their own gas if they're not using a company car, for their own work equipment. So buying steel-toed boots, buying gloves, buying new, wrenches and stripping tools and bags, all of this type of stuff is completely ordinary and necessary because it's both common and accepted in what they do for a living, and it is helpful and appropriate for your business. It's the weird stuff that you just arbitrarily choose to spend out of pocket that is not a facet of the job typically and doesn't necessarily help you that's non-deductible. Most people are not going to spend money out of their pocket for something that is not going to satisfy one of those two, so you very rarely have to worry about it. Common ones that I can think of would be money paid out of pocket by truck drivers for work-related equipment that they might need for helping load or unload or drive, people that are in the skilled trades, electricians, carpenters, construction workers, masons, people who work in medical professions, scrubs, shoes, people who work in the restaurant industry also maybe even have to purchase their own shoes and things like that. Common examples, I've touched this. Another one, dues to professional organizations, subscriptions to trade journals, any employment agencies that you're paying fees to, and union dues. Union dues are a big one, deductible. You're working in a factory, you're working in a skilled trade that has a union of some kind connected to it. Those types of costs, ordinary, necessary for the job, you're paying out of pocket or it's coming out of your paycheck, that's deductible. When you are doing this as well, you do have the opportunity to use the business use of the part of the home the same way that you do when you're talking about doing a Schedule C or any other type of activity where you are using part of your residence as an office. In order to claim that, however, it has to be for the associated expenses for that area of the house. And that's just a really simplified sentence that basically means that you need to have an area of your home that is used regularly and exclusively for business purposes. It has happened before where the IRS has come in and challenged a deduction for the business use of a home and found that maybe the wife was using the closet to store old blankets, and because she walked through the office regularly to do that personal thing, then the entire amount was non-deductible. So if you are talking about a business, you need to be able to convincingly justify the fact that it is regularly and exclusively used for business and not personal reasons, and then you would basically be able to take a part of those expenses on that 8829 from everything from part of your mortgage to part of your electricity or your water bill or whatever, and have that as a deductible expense for the business usage of your home. Doing that, however, also allows you to do depreciation for part of the home, can lower your basis and make you actually owe money if you do sell the home later, because it will reduce the value of the home. Keep that in mind. We do have stuff over depreciation that talks about that. We do have a section or a webinar over the Schedule C that talks about that as well. So I'm not going to harp on it too much. That does go on a Form 8829 unless you're using the simplified method. This is such an audit magnet and probably the source of, I don't know, realistically 20 to 30% of the Schedule A based audits are from business use of the home. The simplified method is the IRS's attempt at giving taxpayers, tossing them a bone, throwing in the towel a little bit, and they have a simplified method that says, hey, you have an area of your house you use as an office, great, $5 per square foot. You can have up to 300 square feet of office. That is $1,500 maximum amount that you can have put on your Schedule A, less chance of an audit. So if you do have somebody that does have an office and you don't know whether they're going to make it, you're totally allowed by the rules to just do $5 per square foot up to 300 square feet. Is what they found was every time they took it to court and they had it challenged, that when it came down to it, that's about how much money people were spending per square foot of actual money in order to maintain that for business purposes. That's going to go on that 2106 from that line 21 of the Schedule A, or you can just simply go to the forms list and add a 2106 right to the return and fill it out, and it'll pretty much go wherever you need it to. Additional deductions, some things that are not necessarily related to the other ones that you might miss or you might not think about. Last year's tax prep fees. You're talking about, your taxes are about your income. Your entire existence for income tax purposes is the production of income. So you're spending money on that activity. Boom, there you go. It's tax prep fees capable of being deducted. Gambling losses. They are limited to the amount of gambling winnings that are reported. Keep that in mind. If you are adding a W-2G to report gambling winnings on the return, there's actually a little line on the bottom of it that says, hey, how much money did you have in gambling losses? So if you do have somebody who's a compulsive gambler, have them keep all their tickets, lottery tickets, scratch-off tickets, receipts from the casino, anything that they can, because they could potentially partially mitigate the effects of a big payout by being able to deduct those gambling losses. Deposit fees or safety deposit box fees at the post office, Ponzi scheme losses, federal estate tax on the income in respect of a decedent. If you're on the hook for estate tax that you're paying on income in respect of a person who's passed away, can claim that. Hobby expenses. If you've ever seen our Schedule C webinar before or are going to in the future, there's a small section that talks about hobby income. Basically, you're engaging in an activity, maybe you make a little bit of money at it, you're not really running it like a business, but you're getting a little bit of cash. You can take hobby expenses up to income. So maybe you like to play war games and you paint miniatures. Occasionally, a friend will buy a set off of you. That's an expensive hobby. Take the expenses up to the income. You can't run at a loss. You can't get a net tax benefit from the expenses from hobby purposes, but you might be able to help partially mitigate into the income that you're reporting on your return. That pretty much covers about all the main categories of deductions that you are going to see. We do have a resource list at the very end that shows the different publications. I believe there are 7 or 8 of them on there that you can explore. Most of the time, though, it's going to be pretty straightforward because it's going to have the physical name right next to the line on the Schedule A. It's almost impossible to get it wrong. It's go from top to bottom all the way through, put the stuff in that it asks, and it'll tell you whether or not you're going to itemize. Now, we're going to start talking about some limitations on your itemized deductions in general as a basis of your AGI. Talk about some differences in deductions versus adjustments, due diligence and record retention requirements that we haven't already touched while we've been doing this. And one of those first things that have been basically reintroduced over the last couple of years are called Pease limitations. These are limitations on the deductions and personal exemptions for high AGI taxpayers. They're named for Congressman Pease, who had originally introduced these limitations in 1991. They went away with Bush. They came back with Obama. And basically what it is that when your income, your AGI, hits certain levels, you start to lose itemized deductions and personal exemptions. For a married filing separate person, they get the worst end of the deal, like usual, $154,950. A single person, $258,250. Had a household a little bit higher at $284,050, and married filing joint, qualifying widower / surviving spouse, $309,900. So if you are looking at incomes in excess of that, what's going to happen is you are going to get a limitation, and it's going to reduce your itemized deductions by the lesser of either 3% of the AGI above the threshold or 80% of the amount of itemized deductions that are allowable for that particular taxable year. So you're either going to lose 3% of the overage or just 20% overall if that 3% is be too high. So if you start getting into AGIs of millions, then it's usually going to probably go over to the 80% instead of a flat percentage point. But it is something to keep in mind. That's going to be one of those two things. Personal exemptions as well do totally phase out. That's not really necessarily the scope of what we're talking about because personal exemptions are separate from deductions, but they do actually limit themselves down. They start 2% loss for every $2,500 in excess AGI over that particular threshold. In regards to how that's going to work, you're never going to have to worry about calculating that by hand, I would imagine, unless you're in the realm of theory. the software is going to do it for you. Once the AGI starts hitting that limit, it's just going to automatically pick between the two in order to help determine, pretty much help determine exactly what it is that you're talking about. Okay. That being said, we do have a couple of examples that we've got here. The first of which is a married couple. So a husband and a wife, or a wife and a wife, husband, whatever, doesn't matter. Married couple for tax purposes. AGI of $365,000. It's pretty good living. Itemized deductions that they have total $26,500 before the limitation. If you're looking at that, 3% of the AGI above the threshold. So you take their $309,900 and subtract it, and then multiply that amount by 3%, you're going to get $1,653. If you take $1,653 out of that $26,500, you're looking at $24,847 in allowable deductions. So their itemized deductions are basically going to drop by a little over $1,650. On the flip side, 80% of the itemized deductions is $21,200, which is a reduction of $5,300. Since it's the lesser of the two, means that they're going to do the 3% limitation instead. So their total AGI is, or their total itemized deductions, looks like this right here is a little bit off. It should be this number right here, $24,847. And that's what they're going to actually be able to claim. The next example that we are going to be covering is going to be is pretty much going to be for a single taxpayer. He's a high-earning bachelor. He's basically living in New York City. He goes to the stock exchange. He's making $1.5 million a year. He's got itemized deductions, $52,500 before the limitation. 3% of that AGI is $37,252. If we take that away, we're looking at him only getting 15 grand, 15,248. 80% of the deductions is 42,000, which is a reduction of 10,500. Obviously, losing 10,500 is less of an effect than losing 15,000, so he's going to be in the 80% category instead, so he can deduct $42,000 flat in itemized deductions on his particular return. Now, what you're looking at is that the 3% of AGI threshold will be the likely way that you do the limitation. It'll be handled by the software. Pretty much every software automatically will be doing this. That right there is probably going to be the most common. The rules being what they are is that you always will basically get 80%. So no matter what your AGI happens to be, is that you will never have more than 20% of it taken away. So you'll always get to keep 4/5 of the amount of allowable itemized deductions and take them off on your return. And you're not going to be dealing with the 80% rule until you start getting into the, the millions in income, which is not a very, there's only a couple thousand people in the country that are going to be in that particular income range in the first place, and very unlikely that any particular office will have that one. So if you do start dealing with it, probably going to be dealing with the 3%. There's also a consideration of a deduction versus an expense. A lot of people use the word deduction, and I can totally understand a colloquial usage of the word, basically money that you spent for some purpose. I get it. Business deductions are called expenses. So if you have a deduction that is related to the purpose of running an income-producing activity or a business of some kind, it's called an expense. Expenses offset taxable income dollar for dollar. Meals and entertainment for most people are still going to be at half value. If you've ever seen our Schedule C webinar or ever seen any sort of materials ever over business expenses, that's pretty much standard. Meals and entertainment get cut in half, but pretty much everything else is a dollar for dollar deduction. They are beneficial whether or not they're using standard or itemized deductions, because you are talking about money that you are spending to make money, so it's just going to come right off the top. Those are not going to be a Schedule A thing. Those are going to go on the various forms. If you're a sole proprietor, that's a Schedule C. If you're running rental or royalty income and you're spending money on it, that's a Schedule E. If you're a farmer, that's a Schedule F. Like, those things are going to go on those forms and reduce that income, and that's going to go on your 1040. It's not going to be an itemized thing at all. And the reason why it's important to bring it up here is because you need to know what amounts they're spending apply to what things. 1099 miscellaneous, they're spending money out of pocket. Well, it looks like they're an independent contractor. That 1099 miscellaneous is probably going to go on a Schedule C. those expenses are expenses. They're business expenses. They're going to go on the Schedule C. They're going to be dollar for dollar. He's going to get a good benefit. He's going to have less income to report. Those go there. If he's spending the same money on the same stuff, but he's got a W-2 instead, those are deductions because he's not running the income-producing activity. He's providing a service in exchange for income, and he's not going to get to take that dollar for dollar. He has to itemize and 2106 it. Qualifying businesses where you're talking about actually taking these expenses and making them expenses instead of itemizing them, sole proprietors, single member LLC, husband and wife qualified joint ventures, rental properties, and as I mentioned before, it also includes things like farmers and fishermen, okay? So if you do have somebody who's got expenses for something, see where it goes. And if you're talking about somebody like, yeah, I want to itemize my return, and I bought some printer paper, and I bought, pencils, or, I got oil change on my car. Well, like, none of those things go on the Schedule A. Like, are you running a business? If so, it's going to go on the business return, or the business form on that return more specifically. You do also have a deduction category that's known as adjustments. An adjustment to income is similar to a deduction. There are some differences, though. Adjustments are deductions that adjust the income to arrive at adjusted gross income. They're called above-the-line deductions. By contrast, the Schedule A, the standard deduction, itemize, all that stuff, those are called below-the-line deduction because those are deducted below the adjusted gross income calculation. Adjustments are used regardless of whether they itemize or not. So you don't have to itemize to take an adjustment. These are taken pretty much standard as a dollar-for-dollar deduction against gross income. Because you got to think about that. Adjusted gross income, what's the key word there? Adjusted. You've got all of your income together, that's gross income. Then you get your adjustments. You get adjusted gross income. If someone doesn't have any adjustments and the two numbers happen to be the same, otherwise, other people are going to get some adjustments on the top of that. If you pay self-employment tax, you'll get a little bit of an adjustment. There are a couple of other expenses like qualified tuition and fees that are not being used for the American Opportunity Credit might potentially be able to be deducted. You're talking about educator expenses. Those types of things are capable of being put on the adjustment. So if they do have some of these expenses and it seems like they think it's a tax effect, you can always check to see if it's going to be an adjustment instead of a deduction against, on the Schedule A. These are going to be calculated on the 1040, most often with calculation from supplementary forms and worksheets. If you are on the 1040 itself, you can pretty much click any of the lines for the adjustments whatsoever, and then right-click or hit the hotkey on the top of the keyboard and open up a big window that says, would you like to add a worksheet to this? And there's tons of little worksheets you can add and fill out that basically will allow you to calculate the proper amount of deduction to carry against your income on that particular form. While we're on the topic of adjustments as well, it's important to remember that that many, if not most, probably all of them are close to it. They fail to separate deductions and adjustments from one another during the interview process. So, I mean, because they're all technically deductions, it's just some are deductions that also are termed as adjustments. They will just put them all on one big line, so that way you can fill it out in the interview portion. So if you are not the type to hop right into the forms, if you are using an interview software platform, make sure that you can say yes to itemizing, or that you at least look through the list to make sure that you're not missing adjustments or credits that they can take even if they're not going to itemize. If you say no to it, you can make adjustment-based questions not appear or credits not appear, and you might miss opportunities for lowering their tax burden, and it's, if you mess somebody's tax return up, they might not get a client. You want to try and, foster that relationship so that way you can have a steady client that comes to you year after year, make this a profitable endeavor for yourself. In many cases as well, a lot of these adjustments are not commonly known to people's clients, or to know these people. They have no idea that they even exist, so it could be an opportunity to educate as well as you're running through it. And some of these adjustments are handled automatically. Self-employment tax, for instance, is going to be automatically calculated the moment you drop a Schedule C on the return. It's going to throw on the Schedule SE. It's going to calculate how much money you should be paying in self-employment taxes, and then any self-employment tax you owe, half of that is considered an adjustment. So if I owe $1,500 in self-employment tax, my regular AGI is going to drop by $750. I'll pay a little bit less in regular tax, because if you remember earlier I said self-employment tax is calculated separately and added after the fact from your regular tax. There's a little bit of an automatic thing there. Some adjustments work like that. So it's not really going to be too time intensive or math intensive. It's just mostly making sure that you know that they exist so that way you can place this information on the return. Most commonly used adjustments: educator expenses, deductions for paying into retirement accounts, tuition and fee deductions, like that one right there, if I'm not mistaken, is on the chopping block or gone, but is potentially going to get added back on. A lot of this type of stuff can come and go year to year, so these things can change. Moving expenses: if you're moving more than 50 miles in the search of work or for a new job, then you can take those moving expenses as an adjustment. Self-employment tax deduction, alimony payments that you are making to a spouse pursuant to a divorce arrangement. All of these things are potential adjustments that you need to keep in mind in the back of your head that could affect the return regardless of whether that Schedule A ever actually ends up being used. There are certain things that are false adjustments, or false deductions, I mean. They often are attributed. This goes back to that misconception discussion I had earlier. They're attributed to being tax deductions, but they're not. Child support: never deductible, never reportable as income. It just doesn't exist as far as the tax code is concerned. Child support is just gone. It's a ghost. It's there. It's the 500-pound elephant in the room. It does nothing to anything. It just ignore that it ever even exists as a concept when you're doing taxes. Cost of living personal expenses: food, rent, utilities. Those are not separately deductible. Those are already reflected in the standard deduction. That's what the standard deduction is. It's what the government, what the IRS determines is the minimum amount to make it in the country and basically survive, like physically survive for most people. So that right there is your food, your rent, your utilities. Of course, many people think it's ludicrously low to represent that figure. That being said, its sheer existence prevents you from doing food, rent, and utilities unless some portion of this is connected to a business that you are operating. Anybody that's ever done a return for a daycare center run out of the home, for instance, knows that they do use a percentage of time in the house, which reflects like all costs or can include food. None of that stuff is relevant for 99% of the people you're dealing with. Personal legal fees, fines, and penalties. Can't do your speeding ticket, and claim that on your taxes. If you get in trouble and you're ordered to pay something back in court, you're not going to be able to take that as a deduction, so you want to keep that in mind as well. Donations to family or interested parties. If you are giving money to other people and it's not for business purposes, you're not going to be able to take a deduction for it. You can't loan your brother $500 to get out of jail or pay his bond or something and take that as a deduction. Anytime you're even trying to take something like that, that's an entirely separate thing. Dealing with like debt obligations and a bunch of other stuff that we're not even going to talk about. But just basically straightforward, giving money to other people just outright, that's not a deduction. It's a personal thing, has nothing to do with your taxes. Credit card interest: you got a credit card, you pay it every month, that interest, not deductible either. Big misconception. A lot of people try it. A lot of people end up getting a letter from the IRS and owing some money. You don't want your clients to be in that particular ballpark. IRS has what's a concept known as due diligence. Due diligence is just basically something that described by the IRS as it refers to the level of judgment, care, prudence, determination, and activity that a person would reasonably be expected to do under particular circumstances. So in general, like the real shorthand version of that legalese is that you can rely in good faith upon client-provided information. So if they tell you it, you can believe it. The one thing that you can't do is you cannot ignore if you find out the information or you reasonably suspect the information is untrue, incomplete, inconsistent, or inaccurate. So you can take their word for just about anything. At the end of the return, they're going to sign the piece of paper that gives the responsibility for the contents back to themselves. So as long as you are abiding by good faith and you are properly asking questions where necessary and you are being on point with your retention requirements and questioning, that you can be perfectly fine. You're operating with due diligence. You just can't ignore it. If you hear somebody talking on the phone outside your building and saying, yeah, I think I'm just going to say I paid this much money in mortgage interest. You can't just take their word for it, and like for a fact that there might be something shady happening. So you want to be sure to probe, to get questions and find out what the truth is. If you don't have any reason to suspect there's anything wrong, then don't worry about it. You can rely on good faith because they're going to be responsible for the return when it actually goes out anyway.
Hey Derek,
Go ahead.
while you're talking due diligence here, that's actually my second polling question, 2 out of 2. If you don't mind, I'd like to go ahead and launch that here. We're getting pretty close to wrapping up, so let me go ahead and pop that one up here. All right, guys, on your screen you should see polling question number 2. The question is, you are generally allowed to take your client at their word when entering and working with itemized deductions. So like Derek was saying, we're just talking about this here. When dealing with due diligence, are you responsible for obtaining physical proof of these deductions? Are you the honesty police, so to speak? That's kind of the general question that we get a lot. And if you would, take your choice there, true or false. Either way, we'll get you clocked in as being present and awake on the webinar. But are you allowed to take your clients at their word when working with itemized deductions? And honestly, this has a lot of bearing on just about all aspects of tax preparation, for that matter. But we'll leave it up there for another 15 seconds or so. Make sure that you get a chance, answer one way or the other. That, like I said, that lets us know that you're out there and participating. Leave it up for about another 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Go ahead and close that down, and I'll post that up there. You really can. You have to be able to take your clients at their word. And as Derek was saying, you have an obligation as a tax preparer that if you notice that something is information is inconsistent or incomplete, you need to address that. You have as a preparer, you're obligated to take that step and ask more questions, to dive a little deeper, dig a little further into that information or statement that might be in question. But you really are, your hands are tied as far as the proof of this stuff. You could extend your average preparation time by double what it normally is if you had to physically go through and validate all the information that you were being given. But thank you for answering that. I'll go ahead and close it out. And Derek, I think we got just a couple more slides here. I'll let you wrap it up.
Absolutely. I guess before I necessarily continue with like reading the slide, just like real quick, as in like 1 minute, I do have a copy of a dummy return here. Just to give an example, this is the desktop version of the software. So you can see the Schedule A over here on the left-hand side. You can see the forms right here. There's little worksheets that you can attach to it. Like we've got a link already to an existing detail worksheet. It's pretty straightforward. Like once you add it on there, whether you're doing it here, whether you go to the interview portion and it pops up, and you actually have the ability to go, through the different subcategories for your deduction amounts. It'll populate where it needs to go on the return, and it'll automatically calculate. And you can see it'll either carry over to the page 2 of that 1040 or basically work there. Okay, so I'm going to go ahead and get back to the slides. Anybody that's doing training or needs some clarification, feel free to call in during normal business hours, and we would be more than delighted to help you work on a Schedule A, show you how it works, try to get the best deal for your clients. And I do want to point out a clarification, because I did see a couple questions about it in the questions panel that got taken care of while the poll was happening. Credit card interest is not deductible for personal reasons on your Schedule A. If you're talking about credit card interest as a category of expense, if it's related to business on a business card, it goes on a business form. Schedule C, Schedule D, Schedule C, Schedule E, Schedule F. But in terms of your personal credit card interest, it's not going to go on there. If it's not a business-related expense, it's not going to go on. It's not going to go on your business forms or your Schedule A. If it's personal, just don't worry about it. I'm not meaning to say that credit card interest is entirely non-deductible. It's just you're not going to deduct on a Schedule A your credit card interest. Business stuff, business forms. That being said, hot button issues for that Schedule A. Charitable contributions, really easy to fake, very hard to substantiate by the IRS. The IRS historically tries to avoid, like the plague, anything to do with nonprofits, especially nonprofits focused on a religious angle, because it's a tenuous political issue in many cases. So they try to avoid that as much as possible. It's really, really, really easy to fake it. So they will try to make sure that the onus of the responsibility for reporting that is on the taxpayer, that you have the proof, that they have the receipts from the organization. So they will come after the taxpayer more so than the organization, because a lot of people will just inflate these numbers dramatically. Form 2106. I mentioned that's really common. Unreimbursed employee expenses, claim way too much mileage, claim expenses for travel that in reality were paid by the boss, meals and entertainment expenses like trying to take their personal lunches as an expense for business purposes, other expenses appearing as miscellaneous deductions. These are all things that they like to watch out for. So when the numbers start looking fishy, if they're all $100 increments, $50 increments, there's no 243s or 187s, it's $100, $250, $500. That's when you can start going, okay, I need to see some receipts. I need to see something to prove this. I can't stick this on a return. It's just going to look bad. Schedule C and E expenses. Those forms are like worthy of their own webinar, but long story short, a lot of people will attempt to take their itemizable expenses and put it on a Schedule C or E to have a loss-only form and reduce their overall income. That's classic tax evasion. The IRS will shut it down. Pretty much they will just about review almost 100% of any Schedule C or Schedule E that is running at a loss that has no income. If you have only numbers at a loss, you have no income, and it's not the first year of the business where that might be expected, it's probably a pretty good chance there's going to be a letter in that taxpayer's mailbox a couple of weeks after they file their return. So make sure that you properly input any of the itemizable expenses on their appropriate form, expenses on their appropriate form, and don't try to mix and match for a greater tax benefit outside of what is allowable by the Internal Revenue Code. Schedule E expenses. As a separate sub tab, you want to make sure that depreciation is entered properly when you are depreciating. Depreciating in general is complex for a lot of people, and when it comes down to like adjusting figures for business versus personal purposes, it can get really, really hairy really fast, and like might even need like professional accountancy type help in order to sort out. So if you're on top of it from the beginning, it doesn't become an issue. Make sure that you are properly determining what needs to be depreciated and what needs to be expensed out in the year that it was purchased. And also double dipping. Do not associate non-rental expenses with rental activities. If you are running a duplex and you are renting the other half of the house out, you don't take your water bill and throw it on that Schedule E. Your half of the house is personal. That's Schedule A material for anything that is a deductible under law. Everything else that you're paying for the other half, that's business activity. Clean cut line. Clean cut line, stick to it, and you'll avoid a lot of problems. In terms of your resources, I got a list of resources here. I'm not going to read these off out of rote memorization. Look any of those up you want. This is available right now. It'll also be available archived in the portal when we finish. All this information essentially comes from these. And then at this point, we're going to go ahead and basically turn this over to the question section for anything that remains. The guides and the worksheet, they're available over there on the side, and if I don't get an opportunity to answer any questions, it's been a pleasure working with you guys this evening.
Hey, thanks a lot, Derek. Nice presentation. Like you said, if you guys have any questions, please feel free. Go ahead, type those in over in the side panel there. We've gone through and answered a few of them kind of as we were going in there. One of which that I think was really relevant was the credit card interest example, and that is that's a perfect example of business expenses go on a business form. So the Schedule C here, for lack of, I guess, going into the corporate type of preparation realm, is what we're talking about. So if you've got a business credit card and you're paying interest on that business credit card, then it's a business expense, and it's going to translate over there onto your Schedule C itself. It's not going to be an itemized deduction of any kind out there. The other couple of questions, I think we really went through most of them throughout the presentation as we're going through there. I had a couple of questions relating to what's my record keeping requirements, as even our polling question kind of touched on. The burden of proof is going to fall on your client, with the exception of gross misconduct on your part as a tax preparer. And Derek and myself and a couple of the other enrolled agents here and on staff just got back from the IRS forums down in Atlanta this year. And the big thing that they are pushing when they are talking about due diligence at the preparer level or at your level is they're looking for a pattern when they look for preparer misconduct. They're looking for not just, oh gosh, there was one really crummy return that came out of your office this year where, you had somebody that earned $10,000 and, is claiming $50,000 worth of charitable deductions. That obviously should raise a few questions when you're doing the prep work, but it doesn't mean that it isn't possible. Could happen. But you know what? If you file 100 returns a year and 95 of those returns all have $50,000 worth of charitable deductions on them to some random church or organization, that's a pattern. And that's when the IRS might ask you some questions about those returns and about those deductions versus just talking to the client and putting that burden of proof over onto the client. So I hope that that helps. All right, got another couple of questions in here. Let's see. Do you think that tax preparers should purchase E&O insurance for your tax practice? And what is the estimated annual premium? Good question, especially when we're talking about due diligence. I suggest it. E&O insurance is pretty darn cheap. I want to say you're really looking around $150 roughly for an annual premium for that preparer type of coverage. Feel free to give us a call here. We've got a couple of different agencies that we can refer you out to that you could talk to about different policy coverage levels and so on. All right, I got another question here. Had a client that came to me and asked if they can deduct their medical expenses for doctors. Is that true? Yes, you certainly can. Medical expenses are an itemized deduction. They are subject to the limitations that Derek was talking about before. So if you're dealing with an elderly type of taxpayer, Derek, you might chime in and correct me if I'm wrong. I think if they're over 64 years old, or maybe 65, we're dealing with 10% threshold of AGI, and if they're under that, we are now at the 7.5% threshold of AGI.
Reversed.
Vice versa.
7.5.
There we go. So your older clients get grandfathered into the 7.5% threshold, and any other clients out there are already susceptible to the revised threshold there as well at 10% level. So I hope that that helps. So just because your client goes to the doctor, pays for a prescription, does not mean that they can itemize that, because chances are that won't meet that threshold requirement there. So Derek, you got any other questions coming across your panel? That looks like all the ones I see on my side.
Yeah, that seems like it's pretty much it for anything that's kind of specific
Okay.
to the Schedule A issue. So yeah, I think we're pretty much good to go unless I see something pop in the last few seconds here.
Great. Well, just a little bit of wrapping up here. We will have this webinar posted in your web portal here in about 48 hours. We're coming up on a holiday weekend here, so it'll probably be a couple extra days here when we get back in, and that'll be posted. Your certificates for continuing education will automatically be reported to the IRS and will also be available for printing or download archival purposes on your portal. If something hits you guys in the meantime or after the presentation, we are here year round. So if you got a question that comes up, don't hesitate to give us a call. We'd be happy to chat. Otherwise, Derek, thanks for the presentation and all the homework going into it. And everybody, we look forward to seeing you here at the next webinar. Have a great one. Bye-bye.